Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
America, welcome back to another round of Sound Retirement Radio. I'm so glad to have you tune in into this episode number 391. The title is Market Volatility and Buckets for a Retirement Withdrawal Strategy. But before we get started, I like to get the day started right two ways. The first one is by renewing our mind, and I've got a verse here for us. This comes to us from Proverbs 27:17. As iron sharpens iron, so one person sharpens another. And then, of course, I've got a joke for you. Do you know why the deer went to the dentist? It had buck teeth. Market volatility can be incredibly stressful for those who are approaching retirement or already retired. And in September, we saw a sharp decline in the stock market, leaving many investors feeling worried about their financial future. However, there are retirement strategies that can help mitigate the effects of market volatility. In today's podcast, I'm going to discuss the current market volatility, and I want to give you a few things to consider. And then I also want to talk to you about using buckets as a retirement withdrawal strategy. We have to accept volatility. And as we consider it, we'll see why the bucket approach might be useful for individuals who want confidence as they retire. Remember, articles, links, and resources mentioned in today's podcast can be found by visiting soundretirementplanning.com and clicking on episode 391. I read a recent article by Vanguard that shows that the first 9 months of 2022 have been the worst year for a 60% stock, 40% bond portfolio since 1928. But there was a bright spot in the article, and I'll post a link in the show notes if you want to read more. The article highlights the fact that the probability of investing success increases with time. I always like to say time is the cure to the volatility of the stock market. That same 60-40 portfolio since 1928 has not experienced a 20-year period with negative real returns. Another way of saying this is that the probability of having a positive real return over a 20-year time horizon has been 100%. Now, of course, past performance is no guarantee of the future, but I'd say that history shows us that odds are in your favor if your time horizon is long and you don't panic during times of market stress. If volatility is the illness of the stock market, then time is the cure. Two of the biggest concerns I'm hearing from people right now are, number one, we are in or heading into a recession. And number two, people are worried about what happens if Putin drops a nuclear bomb on Ukraine. On the first topic of recession, after examining 100 years of economic cycles, we know from history that we are often in a recession before the economists declare a recession. It's important to remember that markets are a leading indicator and tend to fall in advance of a recession, and they start recovering before the end of the recession. Here's a quote from an article that was published by Dimensional. Whether accompanied by recessions or not, market downturns can be unsettling. But over the past century, U.S. stocks have averaged positive returns over 1 year, 3 year, and 5 year periods following a steep decline. The article goes on to say that a year after the S&P 500 crossed into bear market territory, which is a 20% fall from the market's previous peak, it rebounded by about 20% on average. And after 5 years, the S&P 500 averaged returns over 70%. And I'll include a link to these articles in the show notes for your reading pleasure. The next item on the list is the nuclear bomb threats by Putin. What's happening in Ukraine is atrocious, and Putin is a total maniac for even threatening the use of nuclear war. And this is unfortunately a real risk. But, really, if all-out nuclear war were to take place, it really doesn't matter how much money you have or where it's invested. A risk to our investing success is overcoming worry or dealing with worry. And worry can rob you of your sleep and steal away your peace and take away your joy. If you spend enough time with worry, it can bring you to your knees. There's a quote about worry that I heard, and it goes like this. My life has been filled with terrible misfortune, most of which never happened. And it underscores the idea of worry and how worry is a misuse of the imagination. Think about some of the things that have happened since 1940. A nuclear bomb was used in Japan to bring an end to World War II. We've had Vietnam War, Korean War, Operation Desert Storm, Bosnia, Afghanistan, Iraq, Syria, ISIS, Al-Qaeda. We've had government shutdowns, blizzards, Y2K, mass shootings, the Japan tsunami, the Thailand tsunami, Hurricane Katrina, September 11th, Oklahoma City bombing. We had global pandemic and riots and wildfires, tax increases and tax cuts, and Democrats have had a majority in Congress and Republicans have held a majority in Congress. We had the dot-com bubble. We had a housing crash, financial crisis, trade wars, oil crisis, massive inflation, and the list goes on and on and on. It almost sounds like the Billy Joel song, "We Didn't Start the Fire," or maybe it's REM's song, "This is the End of the World as We Know It." But through all of this, look at what the market has done. Those who can stay the course of investing have been rewarded. I read this quote by Ben Bernanke. He says, "History has demonstrated time and time again the inherent resilience and recuperative powers of the American economy. The mistake that is easy to make is that people will say, yeah, but I'm getting ready to retire. I may not have time on my side." If you retire at age 60, there's a good chance that you're going to have 20 to 30 years in retirement. But heading into retirement, it's important to have a plan because life is about to change. It's important to have an investment strategy for this new phase of life. It's easy to focus on short-term pain, but it's better to focus on the long-term gains. Sometimes when things are going bad, we think we need to do something. But when it comes to investing, it's often the case that doing something hurts your long-term results. If you're going to do something, stick to your plan. And if that includes rebalancing, then see if that makes sense. Remember, you made good plans in the good times so that when the bad times hit, you would be prepared and you would stay the course. As an investor, you will experience pain. The pain of being disciplined and staying the course during times of volatility, or the pain of regret by trying to get in and out of the market and sitting on the sidelines when the recovery happens. The key to investing is time in the market, not trying to time the market. It is risky to invest in the short term, but if you think investing is risky, try sitting in a savings account for 20 or 30 years and watch what happens to the purchasing power of your money. If you're too conservative with your money, eventually inflation will erode your savings. Inflation robs us of purchasing power. Worry robs us of contentment. Not having a plan robs us of confidence. We don't want to let fear be the deciding factor in how we invest. And I read a verse several years ago that really had an impact on me. It's when I read this verse and I saw these 4 words for the first time that it helped me to think differently about risk. And so I want to share this with you because I'm hoping that it helps you see things in a new light. In the book of Matthew, chapter 25, Jesus tells the parable of the bags of gold. In verse 25, it says this, "So I was afraid." So I was afraid. Those 4 words, "So I was afraid," and went out and hid your gold in the ground. See, here's what belongs to you. If you want to know what happens to the one who allowed fear to be his reason for not investing, then go and read verses 26 through 30. There are consequences for allowing fear to be your guide. Remember, we're not investing for what happens in the next 6 to 12 months. We're investing for what is going to happen over the next 20 to 30 years. We know from the Dalbar QAIB studies that investors who are constantly trying to get in and out of the market end up with less money, considerably less money. And the reason is that investing results are more dependent on investor behavior than on a fund's performance. We don't want to let our emotions derail a good long-term plan. So rather than focus on the market volatility, look at the plan you created, update your numbers, and see how things look for your specific situation. The numbers don't lie. And hopefully you discover that your plan is more resilient than the negative headlines might have you believe. Having a plan and reviewing your situation through the filter of the plan helps you to know if you're going to be okay. The reason I invented the retirement budget calculator is that I believe that every American deserves to have clarity, confidence, and freedom as they approach and transition into retirement. Every American can have a plan. And when we have a plan, we become resilient. And here are a few quotes that I like about resilience. This one's from an author unknown. It says, "Tough times never last, but tough people do." Benjamin Franklin says, "The things that hurt instruct." Here's one from Rocky Balboa. "It's not about how hard you hit. It's about how hard you can get hit and keep moving." Ralph Waldo Emerson says, "What lies behind us and what lies before us are tiny matters compared to what lies within us." Kobe Bryant said, "The moment you give up is the moment you let someone else win." Nelson Mandela says, "Do not judge me by my success. Judge me by how many times I fell down and got back up again." Thomas Edison says, "Our greatest weakness lies in giving up. The most certain way to succeed is always to just try one more time." Alan Greenspan back in 2005 was giving a speech, and here's a part of his speech when he was talking about the economy. He said, "This resilience, not evident except in retrospect, owes to a remarkable increase in economic flexibility, partly the consequence of deliberate economic policy, and partly the consequence of innovations in information technology." And then one last quote. "My dad had a poster of a rocket ship hanging in our garage when I was a kid, and it had this quote on it from Napoleon Hill. It says, 'Whatever the mind of man can conceive and believe, it can achieve.'" Next, I want to talk to you about new research regarding the bucket strategy for retirement withdrawals and how it can help you to be resilient. The primary reason for the bucket strategy is to help investors cope with the bad times in the market and dampen the sequence of return risk at the onset of retirement. There's a psychological and behavioral benefit when you structure your portfolio in such a way that you know that your diversification includes a time component. The idea is that money you need in the short term is low risk, and money you don't need for a longer period of time can be invested more aggressively. The Retirement Budget Calculator has a buckets tab to show you how a bucket strategy would work for your specific situation. Bucket withdrawal strategies can be controversial. Rob Berger has a video on YouTube where he says that bucket strategies are broken, and I'll include a link to this video in the show notes. Michael Kitces wrote a paper where he said that buckets are an asset allocation mirage, and Javier Estrada wrote a paper titled "The Bucket Approach for Retirement, a Suboptimal Behavioral Trick." On the positive side of the equation, you hear people like Christine Benz from Morningstar, who is a proponent of using buckets. Harold Davinsky was a financial planner who originally introduced the idea of buckets. And Fritz Gilbert, with his popular blog called The Retirement Manifesto, talks about how he creates buckets and manages the buckets in his retirement strategy. Roger Whitney, the Retirement Answer Man podcast, likes to talk about what he calls a pie cake, which is a creative way of describing buckets. Lewis Harvey, the founder of Dalbar, wrote a white paper describing what he calls a prudent man asset allocation using a two-bucket strategy. And of course, Nobel Prize winner William Sharpe created what he called lock boxes, which are similar to buckets but with a time component. In an interview with Barron's, Professor Sharpe said, "The bottom line is that bucketing your assets in annual increments with different initial asset mixes in these lock boxes can provide more efficient production of retirement income over time." So as you can see, there are people on both sides of this discussion about whether or not to use a bucket strategy for retirement withdrawals. In the Retirement Budget Calculator, we have a mastermind community portal. And a little over a year ago, we were having this same debate in our community. John is a member of the community, and he was citing the papers from Kitces and Estrada to make the case against buckets. I challenged John by saying that all of the research up to this point was based on the idea that you only have one asset class in each bucket. So in bucket 1, you have cash, in bucket 2, you have bonds, and in bucket 3, you have stocks. When you build your bucket strategy this way, the conclusion that Kitces and Estrada came to is accurate. But what if the problem was not with buckets as a strategy, but rather how you constructed the buckets, how you filled the buckets? I proposed to John that each bucket has its own asset allocation. By creating an asset allocation for each bucket and rebalancing each bucket annually, you overcome the primary objection to a bucket strategy, which is that you lose out on the positive effects associated with rebalancing a portfolio in a down market and taking portfolio withdrawals. So now, instead of thinking of each bucket as one asset class, you can think of each bucket as an asset allocation strategy. Bucket 1 is cash. Bucket 2 is a 40% stock, 60% bond portfolio. Bucket 3 is a 60% stock and 40% bond portfolio. And bucket 4 is an 80% stock and 20% bond portfolio. Our friend John in the community was not convinced that this was a solution to the buckets problem. John is a physicist and a bit of a computer nerd, and frankly, he's brilliant. And so rather than debate the idea, he built a software application to backtest this new way of creating a bucket strategy for retirement withdrawals. Using historical inflation and asset class performance, he created what he calls a bucket simulator, and I'll include a link to the simulator in the show notes if you'd like to try it for yourself. Essentially, the bucket simulator is a computer program that allows you to test various scenarios using historical asset class returns and historical inflation. There was a time in the past that I used to recommend a 3-bucket plan with 5 years worth of portfolio withdrawals in each bucket. But this was when interest rates were reasonable and inflation was low. As interest rates decreased, we increased to 4 buckets, with each bucket containing 3 years of portfolio withdrawals. And we did this to reduce the cash drag in the overall portfolio. According to a recent article in the Retirement Income Journal, since 1940, the longest it ever took for equities to recover from their pre-crash value came to about 4.9 years. So by having one bucket with 5 years of cash, you would have had enough cash to cover most market downturns and allow time for stocks to recover. Of the 8 periods since 1940 with market downturns, only 2 of them required 5 years to fully recover, and those were the years 2001 and 2008. In 1973, it took 4 years to recover, and the other 5 years with market downturns recovered in 3 years or less. Using a bucket strategy where each bucket is its own asset allocation strategy and where you spend down the buckets sequentially has the following benefits. Number 1, you have the behavioral benefit of knowing that some of the money is safe when you first retire, and this is especially valuable when you start retirement in a tough year like 1973 or 2022. Number 2, you can rebalance within each bucket to benefit from the positive effects associated with rebalancing. Number 3, you create a rising equity glide path. The money you don't need for the longest period of time for portfolio withdrawals can be invested more aggressively. Number 4, you reduce the sequence of return risk at the time when the sequence of return risk is high, which is at the onset of retirement. Number 5, you can simplify bucket maintenance by spending the buckets sequentially, spending the lower risk buckets first, which means no more refills or portfolio rules are needed. And number 6, you can start retirement with buckets, but you don't have to maintain buckets forever. The bucket strategy is designed to help reduce the sequence of return risk at the onset of retirement, and once you're 8 to 10 years into retirement, the sequence of return risk is reduced. Retirement income and portfolio withdrawal strategies will continue to be a subject of ongoing debate and study, which I hope you will participate in. For this backtesting research to be an apples-to-apples comparison, I created an initial asset allocation of cash in bucket 1, 40% stock, 60% bond in bucket 2, 60% stock, 40% bond in bucket 3, and 80% stock, 20% bond in bucket 4. We also assumed an initial withdrawal rate of 4%. Each of the first 3 buckets represented 3 years of portfolio withdrawals. By structuring the buckets this way, the asset allocation across all the segments ends up being 60% stock, 40% fixed income. This way, when you run the backtest of a static portfolio that was 60-40 versus a bucket strategy, you're comparing an initial asset allocation, 60-40 static portfolio, to a bucket strategy that is essentially has a total mix of 60-40 stock to bond at the onset of retirement. The next thing we wanted to do was to model a really bad starting year. A really bad year in recent history was 1973. And we backtested this bucket strategy and compared it to a static 60-40 stock bond portfolio. And what we found was that the bucket strategy, when constructed using asset allocation for each bucket, had a higher ending value than a 60-40 stock bond portfolio that included retirement withdrawals and was rebalanced each year. This is pretty exciting research because it validates the work that so many financial planners have recommended to their clients, and it will encourage additional discussions around the use and construction of a bucket strategy as a viable retirement withdrawal strategy that does not have to be thought of as having suboptimal outcomes while still enjoying the behavioral benefits of using buckets at the onset of retirement to help dampen sequence of return risk. I created a video to give you an introduction to the bucket simulator, and I demonstrate how you can use the bucket simulator to test your own strategies. Just visit soundretirementplanning.com and click on episode number 391. I will include a link to a very detailed article that our friend John wrote, which includes multi-year results, so that you can understand more of the mechanics of how the bucket simulator works and how this new research suggests that a bucket strategy that was implemented in the past would have decreased the probability of running out of money in retirement. It turns out that backtesting this bucket strategy was an optimal strategy when compared with a 60% stock, 40% bond portfolio, where there's a bad sequence of returns at the onset of retirement. I'll include links to all of these resources in the show notes so that you can read the research that's been done up to this point and you can watch the videos and try using the bucket simulator for yourself. John and I were able to have this discussion because he's in the Retirement Budget Calculator Mastermind community. Life is better together. Iron sharpens iron. Sign up for the calculator. Join the community. We'd love to have you join the conversation and contribute to these important conversations. In summary, when it comes to retirement planning, being resilient is key. No matter what the markets throw at you, having a solid financial plan and a withdrawal strategy in place can help ensure that you don't run out of money in retirement.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent, fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.